Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a managing principal and portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other managers. You should always consult the financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, Happy New Year, everyone. I'm sure that most of you, like me, are glad to see 2020 in the rearview mirror. I know last year was challenging for many of us, and I just hope we can look to a brighter future ahead. And while 2020 was devastating to many families, I think the stock market had a completely different experience. We all know that tech was a big beneficiary of the lockdowns in 2020, but here I wanted to share with you a chart of the broader markets, which shows that a rising tide does lift all boats. After a painful start to 2020, stocks rallied to finish the year very strong. Small caps led the way. They were up about 20%, followed by large caps, which were up just over 16%. The Dow Jones Industrial average managed to squeak out a gain of just over 7%, which basically matched the bond market in its entirety. That said, it's important to remember that we spent nearly 8 months in the red, and it wasn't until really the fourth quarter that we saw some real strong positive returns to finish the year. If we break it down by quarter, it's clear that the first quarter was painful, but the injection of federal stimulus and the extraordinary actions of the Federal Reserve boosted returns in the second quarter. And as the economy began to reopen, albeit slowly, the second half optimism started to take hold, and it propelled stocks higher with the leadership rotating from large cap tech to small caps towards the end of the year. Now, most of you know I don't believe in the buy and hold strategy for good reason, and feel that active risk management is a better investment strategy. Looking at 2020, if you were a buy and hold investor, you experienced a pullback of about 50% from high to low in the first quarter. Some of you may have even thought back to the financial crisis of 2008, panicked and sold at the bottom, and missed out on the entire recovery for the next 9 months. The reason many investors underperform is really because of emotions. When things feel good, they stay invested. When things feel scary, they panic and sell. The result is buying high and selling low, the opposite of what investors should do. Having an active strategy focused on risk management is at the core of what we do for our clients. Our disciplined process not only helped us minimize losses in the first quarter, but it also allowed us to outperform for the year. Now, many of you know that I separate my models into both long and short-term allocations. The shorter-term allocation allows me to be defensive when conditions warrant and add exposure when things reverse. If things look bad, I can increase my cash position. I can turn to bonds if valuations are favorable. I can overweight or underweight stock sectors and market caps. And from time to time, there may even be value in alternative investments that offer some unique benefits. A disciplined process, though, is essential to portfolio management. Otherwise, you're going to allow all your emotions and other external factors to dictate your investment decisions. Here I have my core equity model showing the month-end exposure to various asset classes. As the chart shows, I started the year defensively and began increasing my stock exposure in the middle to the end of March, about the same time that we were feeling the most pain in the stock market. As the second quarter unfolded, the market rallied and I began reducing large cap stock exposure as we climbed back to the highs that we saw in January. I did that in favor of bonds and some alternatives. I then rotated into small caps, energy, and industrials in the September-October timeframe, and that was because conditions were much more favorable for those areas. The point I'm trying to make here is that there are times to be a buyer of stocks and a time to be a seller of stocks. You don't always need to be fully invested in order to outperform. You got to remember, the less you lose, the less you need to recover. Now, when we look back at 2020 and take a look at our month-end holdings, the core equity model averaged just about 65% exposure to stocks, about 19% in cash, 9% in alternatives, and 8% in bonds. Even with only 65% exposure to stocks, we were able to outperform the S&P 500. By the way, I'm using the core equity model as an example for time's sake. If you want specific information on the performance of this model or any of my other more conservative models, just send me an email and I'll be sure to get that information over to you. Okay, so I thought I would dig up this old slide that we've used in the past. Successful investing really requires much more than just picking stocks and bonds. It requires a thorough understanding of economics, earnings, markets, and valuations. And just like a car needs an engine, transmission, gas, and tires to run, understanding these four critical components will determine your investment strategy and will help you get to where you need to be. So let's take a look here. As far as the economy is concerned, it's not doing well. I'm going to talk a little bit more about this in just a moment, but earnings right now are okay, but there's a greater and greater divide between growing tech companies and the rest of corporate America. For the sake of time, I'll be talking more about earnings next month as we're just about to start reporting season. Valuations are clearly stretched by any measure. Stocks are not cheap. Certain sectors are more attractive, but overall, the market is way ahead of itself. The 12-month trailing PE ratio, which measures the value of the stock market, is nearly 39 times. And while the market is ignoring valuations, at some point, valuations will matter, and that's going to cause the market to reprice. Said differently, it's going to cause it to sell off. And then finally, the markets, they're on fire. It seems like we're hitting new highs every day. And if you look at the market, you may be scratching your head and trying to figure out why that is. If the economy is terrible, earnings are just okay, and valuations are extended, how can the market keep going higher? Well, I'm going to be focusing in on two of these components today, the economy and the markets. Now, you don't need to be an economist to know that the economy is struggling. We have high structural unemployment that has resulted from the lockdowns. We have permanently eliminated thousands and thousands of small businesses. There's a huge divide between the lower and income classes. That's only going to grow even further. We are running higher and higher deficits, resulting in higher and higher overall debt levels. And in order to fund these high deficits and high debt levels, the Fed has basically embarked on a QE forever policy with a zero interest rate policy. The result of this is that there's going to be much lower economic growth going forward once we get past the euphoria of additional fiscal stimulus. Remember, the federal government can give the economy a shot of adrenaline in the near term, but it cannot fully remedy the damage that's been done by just throwing money at the problem. So why is the market doing so well? Well, the stock market is not the economy. Right now, the market is being driven by liquidity and liquidity alone. Trillions of dollars have been pumped into the financial markets, and that's driving the markets higher. Free money leads to risk-taking, and the result of that is higher stock prices. Part of this forced risk-taking is the Fed. They have monetized our debt and have repeatedly said that they're going to do whatever it takes to support the economy. What they really mean is they're going to do whatever it takes to support the stock market. This isn't anything new. We've known this for quite some time. However, what's changed is the expectations of huge stimulus packages coming out of Washington under the new Biden administration, which also has both chambers of Congress in Democratic hands. And because of this, the market could care less about valuations right now. And while the economy is not the stock market, the disconnect between the economy and the stock market cannot last forever. The economy is the foundation for growth, and if it doesn't heal quickly, stocks are inevitably going to have to adjust. So let's take a look at some of the what the market is betting on. And with this new administration coming in, both sides of Congress controlled by the same party, the market is basically betting on more and more money coming from Washington. The Biden campaign has made some huge promises on the stimulus front, so let's take a look at just some of these. First, he's promised $700 billion for clean energy jobs, doubling of federal minimum wage, and providing money for employees to stay home if they're sick. His proposals also include $2 trillion for what he calls the clean energy revolution. This will be spent on climate change initiatives, ending subsidies for fossil fuels, clean energy R&D, and rejoining the Paris Climate Agreement. He also provides $2 trillion in infrastructure spending in what he calls the Build Back Better initiative. This is going to focus on the nation's rail system, charging stations, and improving battery technology for electric vehicles. On trade, he's proposed $300 billion to eliminate or reduce tariffs and work with trade partners to restore America's leadership in clean energy, AI, as well as battery technology. Obviously, these are just some of the initiatives. This doesn't even begin to touch on any potential state bailouts that'll be proposed. But whenever you're talking about spending initiatives like this, it's going to require raising taxes. And he has proposed about $3.3 trillion over the next 10 years, primarily for corporations and high income filers. Now, if we just took, look at these initiatives and you just say, okay, if this is all that's going to pass, you're looking at over $5 trillion in spending. And this is why the market continues to move higher. The real question that people need to ask is, can Congress really pass this much spending in such a short period of time? And I just personally don't believe that they can do so. So what can investors expect in the coming weeks and months? And I think the most broad point is that volatility is going to return to the markets. And just because Democrats control the White House, the Senate, and the House of Representatives, it doesn't mean that everything is all calm in Washington. There are very different constituents within the Democratic Party, and it's going to be interesting to see who prevails. Remember, there are going to be 35 Senate seats up for re-election in 2022, so senators are going to need to justify their votes on any stimulus package that they vote on. My guess is that the result of the stimulus package is going to be disappointing, and that could be the single biggest risk to the stock market. And we said earlier that valuations don't matter, but they will matter at some point. As interest rates continue to creep higher, it becomes harder to justify these high current valuations. Any disappointment in the stimulus package or any increase in taxes, which I think has a good chance of happening, at least on the corporate side, all of that is going to cause valuations to reset. And so we're going to end this video with where I started from. Having a disciplined investment process that is focused on risk management will matter just as much in 2021 as it did in 2020. As I mentioned earlier, if you want any more information on any of my models or performance, just send me an email or give me a call and I'll be sure to get that over to you. As always, thanks for watching, and I hope to see you again next month.